Hey gang, Steven Sitkowski here, founder of the Sitkowski Trading Academy. I've been teaching people how to trade the financial markets now for 3 decades, and I want to share with you an idea on a particular trade that I came up with this morning. And again, this is not a trade recommendation. I'm not suggesting you go out and do this. It is for educational purposes only, but the trade is on Netflix. So how about we check out what is going on with Netflix. I'm going to show you a chart, and here we go. All right, let's put in the symbol. All righty, take a look at the chart. So first of all, let's look at the last 6 months. I want you to tell me what you see when you look at this chart. Now, you can't actually tell me, but you can certainly have your own thoughts relative to what you see. So this is the last 6 months. So Netflix was going up, 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 right? That yellow line is a 30-day moving average. The white one is a 5-day. And notice the 5-day cross below the 30 here, and then it went above. And what's happening here? Netflix is kind of rolled over. So to me, I see a ceiling on this right here at $450 a share. Everybody got that? So I don't think Netflix is going above $450. So there's a couple of different ways that you can play this. You could buy a put option. So if we were to look and we go, okay, well, MACD just turned red. The RSI is going down. We're still above the 30-day. We are below the 5-day, however, but that becomes a little speculative. I mean, it really and truly does. Now, if you buy a put option and the stock continues to go down, you can make a whole bunch of money. But if the stock stabilizes or goes up, then you can lose money. You can lose it just as fast as you can make it. Plus, options right now are pretty expensive because implied volatility is still relatively high. So let me give you another way to do this. It is something known as a bear call spread. And basically what we're going to do is we're going to sell a call with a strike price of $450 on it. So we're selling somebody the right to buy the stock for $450. They're not going to want to exercise that right unless the price of the stock went above $450. I don't see it happening. And even though I don't see it happening, I'm going to protect myself, right? So I'm selling somebody the right to pay $450, but I'm also going to buy the right to buy this stock for $455 just in case. So now that's a hedge. I have limited my risk. So if the stock went to 500, well, somebody's going to come to me and go, hey, I want to buy it from you for $450. I have a call option, so I can go buy it for what? For $455 and deliver the stock to them. So let's see what that looks like. I know what it looked like earlier when I went on and did this. So I went out to May 15th. So that's just 17 days from now. So the probability of Netflix going above $450, well, I will give you a statistical probability here in a minute. So the delta on the call is 0.15. So what that means is, according to the Black-Scholes model, there's a 15% probability that Netflix is going to finish in the money, finish above 450, 15%. So there's an 85% chance that it's not. So the chances of this trade working out profitably for me, from a statistical perspective, 85%. So I'm going to sell the 450. So that's why there's a minus side and it shows up red. Now, just in case this thing takes off, and by the way, one of the other things I've already checked is there's no earnings announcements in the next 17 days, so I don't have to worry about that. You always want to check earnings announcements. So if I buy the 445, so it puts the trade up here. This is a risk graph on it. So let's hit the trade button. And it will load this up for me. So you see there's a bid and there's an ask. So the bid is 46 cents, the ask is 70 cents. If I try to go somewhere in between those, I'm probably going to pay in the neighborhood of, or excuse me, I'm going to get a credit. Let's see here. So we're selling the I need to modify this. I'm buying the 455. I'm thinking, why does this trade not look like the one that I took? It's why you always check this stuff. Okay, so what am I going to get for a credit? So it shows the midpoint would be 57 cents. I'm going to give the floor trader something better than the mid. So I could get into this and probably get a credit of about 55 cents. All right, so what does that mean? 55 cents, so for each contract I pick up $55. If you did 10 contracts, you would pick up $550. Boom, that would instantly hit your account. Here's what you're hoping, that the price of Netflix stays below $450, both of your options expire worthless. You just keep, if you did 10 contracts, the $550. Now, what is the maximum risk? The maximum risk is the difference between the two strike prices minus your credit. So, difference between the two strike prices, $455 and $450 is what? $5. If your credit is 55 cents, so what is your maximum risk? It would be $4.45. What is your maximum reward? 55 cents. So if we take 55 cents, it gets divided by 445. What does that end up being? Well, let's do the calculation. So 0.55 divided by 4.45 equals 12%. So if you get filled with a credit of 55 cents, you're going to get assuming both options expire worthless, it stays below 450, probability of that 85%. Statistically, you're going to make 12% in 17 days. So how do you take the trade? Plug it in, click review, and then read it out loud. Sell to open, Netflix, May 15th, that's the expiration, 2020, 450 calls. Buy to open, Netflix, May 15, want to make sure the expirations are the same, 455 calls, so that's my hedge, and submit. And let's see what this looks like. I'm doing it in a virtual trading account. I already took the trade earlier today in an actual account. So it shows live. So it hasn't been filled yet. We'll see if it gets filled later on in the day. So these kind of trading strategies are just great when there is either a ceiling or a floor, and when options are expensive. So we have both of those things in play right now. So we're putting the trade on. We're going to watch it every day. If it gets too close to 450, then I'll make some kind of an adjustment. Now, if you don't know how to make trade adjustments, this is not the right trade for you. So this is more of an advanced strategy. But again, if you can make 10 to 12%, 17 days on a relatively low risk deal, that's the kind of a trade I'm all about. So thanks for watching. If you are not a current subscriber, go ahead and subscribe. And you can see every time I post something, click on the notification bell. Then you get notified in real time as something gets put on the site. All right, until next time, stay safe, be smart. God bless you. And remember, we're all in this together. I'll be talking to you soon. Bye for now.